Hey guys, hope you're well. It's Alessio. You may remember a few months ago I went to Iran, and when I was in Iran, in the capital Tehran, I decided to make a video about an important mistake that people are making. Actually, it's a mistake I've made myself several times. And I want to explain to you why this mistake matters and how you can avoid it. So let me go ahead now and play for you this video that I made for you in Tehran, because it's very important, especially when it comes to chart analysis. All right guys, so join me now in this video. Alright guys, welcome back. Before we start though, let me just tell you where I am. I'm standing in front of one of the most well-known landmarks in Iran. This is actually Azadi Tower, or Azadi Square, in central Tehran. And as you can see, it's a really wonderful looking building. By the way guys, one more thing. This place where I'm standing right now has a lot of history behind it. For example, this landmark, the Azadi Tower, is a place where in 1979 there's hundreds of thousands of people, perhaps millions, circling this tower, and it's supposed to represent freedom. Alright guys, so what is the biggest mistake that I've made, and I keep making all the time, and the biggest mistake I see other people making as well? I would say one of the biggest mistakes people make when it comes to the markets, with Bitcoin, with the stock markets, is the fact that people assume that if there is a certain news event that's going to come in the future, or some kind of fundamentals news event or some kind of fundamental event, that's going to have a major impact on the price in the way we expect. Let me just give you an example. Take the jobs report. People often assume if a good jobs report comes out, like a job report says that unemployment has been reduced, that the market will like it and go up. And the reverse is also true. People assume that if a bad jobs report comes out, that the markets will crash, will drop. However, guys, as I'm sure you know and you've noticed, that is not the case. Often a bad jobs report can come out and the market can actually go up. So the market can do the opposite of what the jobs report is. And I'll give you a very famous one. Actually, I'm going to walk towards this tower. I'll give another example. Back last year, so in March, April of 2020, one of the worst jobs report in history came out. So again, remember, this is the start of the COVID crisis, the pandemic. And what did the market do? The stock market went up. It actually went up quite significantly, and people were shocked. In fact, just to show you, here's what happened on CNBC. Jim Cramer was talking, and this was the headline as Jim Cramer on CNBC was talking about the markets. The market has one of the best days. The Dow had a fantastic day. The Dow went up. At the same time, one of the worst jobs reports in history came out.
Dow gaining another 559 points today? How the heck is that even possible? Well, why don't we start with People's Exhibit A against both me and the market. Here's a picture from last week when the wild rally had been cemented in the history books. The Dow's best week since 1938. Then my head. Then breaking news. More than 16 million Americans have lost jobs in 3 weeks. 16 million. And I agree, it's messed up.
So guys, just remember, this is complete nonsense. When people say, oh, a bad jobs report means the markets have to go down. Complete rubbish and nonsense. The same thing happened with the COVID numbers. You know, as the numbers, the coronavirus cases went up, what did the market do? The market actually went up too. In fact, the markets, the stock market, the S&P, went up 70% at the same time as we had rising cases of the virus, rising cases of COVID. And by the way, all those people out there who thought that the exact opposite would happen, that as COVID cases would go up, that the stock markets would crash, were wrong. By the way, let me just say this. Even though I was right to be bullish on the stock markets back in 2020, I did expect that if there was a second or third wave of the virus, I actually thought, you know what, that actually could cause panic, uncertainty, and the markets would drop. That was wrong. So you see guys, even I myself have made this mistake where I expect some news event, some fundamental news event's going to happen in the future, and the market would respond to it badly. It doesn't happen that way. It doesn't work that way. So guys, remember, this is my point. My point is that even if you expect some bad news to happen in the future, and it does happen, for example, it's a mistake to assume that the markets will respond the same way you expect it to happen. Hey guys, it's Alessio from the future here. I noticed when I was editing this video that I forgot to mention another important example of when price action doesn't quite match with fundamentals is, for example, what happened at XRP or Ripple. You may remember there was a lot of bad news surrounding Ripple and XRP in December of 2020 and in early January of 2021. But despite all that bad news, for example, there were rumors that XRP could be delisted from the exchanges. Despite all that bad news, price action ignored all of that and managed to continue going higher. And by the way, we actually got that right, you may remember. We actually got bullish on XRP despite all that bad news. All right guys, let's get back to the video. So guys, this is my point. My point is, just because we expect some fundamental news event to occur, it does not mean that the market will respond the way we expect. I'll give you another example. Just last year in 2020, a lot of folks were speculating that the halving, Bitcoin halving, was going to have a spectacular, phenomenal event on Bitcoin. Did that happen? No. In fact, a lot of the stuff, a lot of the activity on Bitcoin was already built into the price. My point is that when the Bitcoin halving occurred, nothing actually happened on Bitcoin, nothing spectacular, because the price action on Bitcoin had happened before the halving event. Bitcoin had already gone up quite a bit before the Bitcoin halving event. And I'll give another example. Let's talk about gold. One mistake I made about gold in the past was I assumed that if there was going to be a war between countries, I assumed if there was a crisis, for example, in some countries, that gold prices would go up. Didn't happen that way. So guys, the point I'm trying to drive home here is this. It's a big mistake to assume that news events, fundamentals, or some kind of news narrative is going to have the impact that you think it's going to have. That news is going to push the market in the way you expect. Actually, usually it's the opposite. And I'll give you an example of this. Let's say the price is in a trending environment. Let's say, for example, that price is going up, trending upwards, and it's pulling back to a moving average. So let's say the price has been trending up and then pulling back to a 21 moving average, and then as it pulls back to the average, some bad news comes out about jobs reports, or some other kind of bad news comes out to do with the markets or the economy, and the market goes up. Now, why does it happen? Nobody really knows, and it's pointless to speculate. The fact is, the reasons don't really matter. What matters is the technicals, the price. Remember guys, price über alles, price over everything. So, go with what you're seeing on the chart, what you see on the price action, not what you think is going to happen because of fundamentals. What matters is not the news itself. What matters is the reaction to the news. Guys, remember, the markets are made of people. I mean, what is the market? It's human beings, it's people. And what are human beings? Human beings are irrational, we're emotional creatures. So if you've ever seen the market do the exact opposite of what you thought is going to happen, doesn't make sense, that's because human beings don't make sense. Human beings are irrational, we're emotional creatures, right? So remember, it really is about crowd psychology, the psychology of the market of human beings that drives the price action. It's not the fundamentals. And that's why I say the news itself is irrelevant. What matters is the reaction to the news itself, how people react. For example, if a bad jobs report comes out and the price goes up, well, one reason could be that the news itself wasn't relevant. What matters is the trend. What matters is the price become cheaper and people decided to buy at a lower price, driving the price up, and the trend continues. So trend, momentum, the charts, price action, that is what really matters, not fundamentals and news events and things like that.
Most people look at news and events and so-called fundamentals to decide where markets are going. But I think people using the fundamentals are mostly lost because the fundamentals lag what the market is actually doing.
My point is in this video simply is this. The key lesson is never assume that price action or the charts, any market whatsoever, this Bitcoin or stock markets or currencies or gold, never assume that a specific news event will have the impact you think it's going to have, okay? So always go with what you see on the chart. Doesn't really matter what the news itself is. So guys, in front of Azadi Tower here in Iran, in Tehran, I'm going to wish you a fantastic night or a great day. I'll see you guys in the next video update. Cheers.